Good afternoon. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. You can learn more about us by checking out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EK Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative product. Today is February 23rd, and it's the afternoon. And Andy, I think we know our starting point today. It'll be the geopolitical arena. If you could, just give us a little background on how important Russia is to the oil markets and what sanctions might bring.
Okay, good afternoon, everybody, or good week, or if you're hearing this, whenever you're hearing this. Hope you're having a good day. But let's talk about Russia and its role in the energy world. I think from a geopolitical standpoint, most of you have been following the developments with Russia and Ukraine. And I'm not going to do a play-by-play on the developments, but what I am going to talk about are some of the numbers that the market has been obsessing about, rightly so. Russia is one of the largest oil producers. Last quarter, they probably produced about 11 to 11.1 million barrels a day of crude and condensates. Crude was probably just around 10 million barrels a day. They're also one of the world's largest exporters of both crude and refined products. Crude exports globally of crude and condensates are over 5 million barrels a day. And of which half of that goes into Europe, the other half to Asia. Europe exports through pipelines, as we know, and also via waterborne transport. They're also a big exporter, as I said, of refined products. It's probably 1 million barrels a day, at least. Of which most of that is gas oil, some gasoline, and of course heavy products, as well as some NGLs. They are also as we all know, a major exporter of natural gas. They export probably 33 to 35% of Europe's needs through a variety of pipelines and through LNG exports. They, as we know, the pipelines go through through Ukraine and also through Western Europe. Now, look, getting back to petroleum for a second, what I neglected to say is those crude exports to about 20 to 25% of European crude runs. So the Russian barrel is really important to European refiners, both in Western Europe, Southern Europe, Eastern Europe. Russian crude finds its way into into the crude mix, and certainly a loss of that big of a supply would be really devastating for refiners in Europe, which is why the market, of course, has been rallying sharply over these last couple of weeks as a potential invasion of Ukraine becomes more and more realistic.
It seems like the sanctions are not going to restrict the flow of energy out of Russia, at least for now. I don't know if they'll ramp up the sanctions to do that, but it's you get a sense of a premium in crude, or is it there's just so much going on? It's hard to for this potential of lost Russian barrels. Do you have a sense of how much? Where would we be if Russia backs away?
Well, given that there's
An,
been,
an unlikely event, I think, but
well, that's really hard to measure, Jim, because given that it looks like incredibly the nuclear deal is about to be signed, which is putting some pressure on the market and probably taking away some of the premium. I mean, I had really thought that somewhere between $5 and $10 might be a premium to the market. I guess we'll certainly find out. But those are the numbers. Yeah, that kind of number, I think the market has assigned a premium. I mean, certainly there's been a lot of talk about $100. Jim, you've been talking about it since last year with those options, right?
yeah,
Uh,
I was. It's interesting what we saw. I'll bring up the options early this time because it's pretty interesting what we're seeing. But yeah, early in 2021, we start seeing people buy calls, $100 calls, and for DEES of 2022, and it still remains the largest open interest strike over 60,000. There's been obviously more call buying and call spread buying as we rallied, and so this kind of the option market, I wouldn't say anticipated it, but it's not freaking out like it did when the market collapsed in around Thanksgiving when the Omicron virus hit. So, it's a little more orderly. However, we just saw March WTI options go off the board on February 16th. And previous to that, there was a lot of stuff in the press talking about an imminent invasion on February 14th. And so what we saw going up to that 14th was the skew flipped. So the skew is the sort of the out of the money put vol measured against the out of the money call vol. So typically oil has a negative skew. To think about Mexico buying 200 million barrels to 300 million barrels worth of puts, and basically it blows out the volatility on the downside put. So we compare, usually use a delta of like 25 and compare the 25 delta put and 25 delta call. And it's usually negative. And it flipped, it peaked on the 14th of February in the March option, and then March went off the board on the 16th. And so those, it didn't happen. So they didn't those a lot of those options expired worthless. But at the same time, while this is going on, we're seeing a lot of put buying as well. So the pattern many days is that you see a lot more calls trade than puts, but put open interest is increasing more than calls. So that's partly you're seeing call spreads, but you're also seeing people liquidating, getting out of their call positions that they put on, at much lower prices. So, you say, well, so options world is a perfect place for people to sort of put positions on that reflect how they feel and the risk they want to take. So, you want to protect against or profit from a move up in oil prices. You buy calls because you know exactly how much money you're spending on that play. In the case of these March options, you lost the premium you paid out. So at least you knew the risk going in. It's not like futures. So on the downside, you got these high prices, and maybe people are looking at Iran coming on. And you're seeing expansion, like we'll talk about in a few minutes. In the U.S., producers are looking to produce more oil, and a lot of them had hedged using futures at much lower prices, and they hadn't participated in a lot of this rally for some of their crude. And so at these prices, a buy put strategy makes a lot of sense, because if there is, Russian oil taken off the market, or a serious war breaks out and prices soar, producers will still, participate in the high price, but they'll have this downside protection. So again, it's a perfect market for options for these conditions. However, it's not free. Nothing's free. So this call buying and put buying has bid up the volatility to about 45%, which doesn't seem a lot. I think we were over 60% during the decline in price back in after Thanksgiving. But at $90, 45% vol is pretty high. Just think about, we set an all-time record low back in 2014 in the low teens of volatility, when the price is 100. So typically when you see prices high, the vol in crude tends to go down. So 45%, the long-term average is around 33%. So it's like 10, 15 points over its average. So basically it's telling you there's something, potentially going on that would create a very volatile market down the road. So, but that's kind of what we're seeing. We even on this rally, we are seeing some put buying and put open interest increasing. So, and that skew I talked about is still positive for April options. It's off its high though. So, but it's still in that weird sort of not usual situation, obviously, because of Russia Ukraine situation,
and throw in Iran.
And Iran, yeah. And then yes.
And we're in an environment of very low inventories, exceedingly low inventories. We're running globally, OECD inventories are something like 220 million below the 5-year average. A number of days supplies below the day supply below the 5-year average, which certainly, I think, adds to the volatility in the market. It isn't like you can just go into storage to make up what could be, any type of shortfall. You have to buy the physical, and as a result, we're seeing huge premiums on the physical market. The BFO is trading something like $3 over dated Brent. So, you're looking at physical prices, in over $100. So we've actually been over $100 on the physical market.
Right. Yep. It's kind of, yeah. And that's the reason why people were buying calls all last year, is they're anticipating this tightness.
Right. That's the fundamental part.
Yes. Exactly.
No doubt. I mean, the market has, as I mentioned on the inventories, we've had, I guess this is going to be this quarter, there could be a slight build, but if there isn't, it will be the 8th consecutive quarter of drawing stocks.
Why don't we talk about that? Because I guess the EIA and the IEA are looking for oil surplus down the road, right. Despite, I mean, I'm sure they're expecting Russian oil to be on the market, but how do they come to those? And you're looking for a surplus. How do you come to that? Why don't you take the demand side?
I'm still looking for slight surpluses. This is without Iran. I have a surplus this year of about 500,000 barrels a day, with slight increases in in every quarter. And what I'm looking for, it looks like non-OPEC production, we're going to have a nice increase. At least I think it's going to be well over 3 million barrels a day of increase from non-OPEC producers, who will help to make up some of the shortfall, not all, but some of the shortfall from OPEC plus. We're going to see, I think U.S. production is going to be up over 1 million barrels a day. throw in an increase of 400 to 500,000 barrels a day of NGLs, and there's 1.5 million right there from the U.S. Canada too. I think you're looking at a couple of 100,000 barrels a day, and there've been positive developments in Argentina. The Vaca Muerta is actually showing some.
It's alive.
Yeah, it's alive. It's alive. Guyana as well. Russia too is expected. Now there you don't know, Jim. You don't know where those, you don't know where Russian production is going to, come in on.
Right.
Whether they reduce production to, counter the West. It's obviously very unclear, and Iran too, is unclear to say the least. But let's talk about Iran, because that's really important. Iran is producing 2.5 million barrels a day. Before we pulled out of the JCPOA, they were 3.8. So, it's possible that they can provide quickly 500,000 barrels a day at least, and possibly up to 1.3. The other thing about Iran, there's 90 million barrels of Iranian crude and condensates in storage. So, we could see as soon as, I thought it was May, but I guess the administration was talking about possibly as early as April. Were they talking March, Jim?
I saw a blip from a comment that Jen Psaki mentioned that oil could come out within within days. I assume they mean after the negotiations are making progress. I assume they mean oil could come out within days after they agree. But they're probably ready to roll.
Yeah, well, that'll be all about the architecture of the waivers and how the sanction could be lifted. But that's a fairly significant. That'll change the balances again, depending on where where Russia comes in. But Russia is supposed to grow this year, crude plus condensates. They could be up 700,000 or 800,000 barrels a day, just assuming that nothing else happens. But that's a huge assumption, to say the least.
Yeah, right. This podcast may have a shelf life of a few minutes based on the way that things are developing, but we just have to go with what we can go with right now.
Right.
So let's look at on the demand side, Andy. There are a lot of countervailing forces as usual. I think most of these, the big three, have demand increasing maybe 3.5 million barrels this year.
Right.
And
yeah, that's right.
Where do you come out on this? And
we're right. We're pretty close to that. We're at 3.6 for demand for CRG's estimates. So we're right. We're right there. Some analysts are looking for like 4 to 4.5 million barrels a day increase, and I haven't changed them yet. But if I do, I think it's going to be a downside correction, Jim. On the demand estimates. Certainly the virus has it seems it's having less and less of an effect on demand, and as you pointed out, there's a tremendous amount of pent up demand, and hence I think that's one of the reasons why a lot of analysts are looking for a lot of the banks are looking for big increases. When we start seeing increases in gasoline, jet fuel certainly, and diesel. But we'll have to see what higher interest rates, what inflation, what a possible wider war in Europe brings to the demand table. So
not to mention hefty utility bills from the wintertime.
Yeah, that's a great, right, exactly. I mean, people are going to go into shock when they start seeing their January and their January bills, and certainly Europe has gotten absolutely clobbered.
Well, I know I bring up New York often because that's where I live, but we don't we restrict pipeline flow of gas from Marcellus region, which is just stone's throw across the border, and a lot of people voted to not frack in New York and not allow gas. And guess what the big complaint is? Everybody's complaining about their gas bills.
Right.
I wish
Yeah.
somebody would explain, this is this causes this, but that's not the way things work. But yeah, we have access to it, a whole reservoir of gas not too far away. We can't get at it. But anyway, it's a real problem. Utility bills. It's a problem for the Northeast, but it's also a big problem for, as you talked about, Europe is getting clocked even worse than we are. So that's got to take some. I don't know. How do you react to that? Do you still do as many trips? Do you drive? I don't know, but we're going to find out.
Yeah, I mean, people are going to have, certainly less to spend, unless wages keep up with inflation, and then you don't know about sentiment. So plus if we're not growing, if U.S. if global GDP growth is stifled at all, obviously that's going to have an effect on demand. So I think a lot of these demand forecasts may be too optimistic. As I said, I haven't changed mine yet, but I'm not that far away. We'll see what happens. We'll see how events develop.
Yeah, it's a moving target. I mean, it looks like more companies are going back to the office, in mid to late March. So there's all these countervailing forces, and I'm guessing that your demand number, as the IEA, the EIA, and OPEC's demand number, will be revised often over the next few months.
Well, the IEA just gave us a nice revision. They just decided to let's add 800,000 barrels a day to our baseline.
Yeah.
Which made a lot of sense because of they always had imbalances on their balances.
The missing barrels.
Yeah, the missing barrels.
They found
the
them.
Missing barrels have been found.
Yeah, I think they found was it China petrochemical demand and the Saudi LPG consumption.
Right. That's exactly right. Those
Yeah.
are the two biggest factors.
Yeah, it's hard, as you know, Andy. It's hard to count all the barrels all the time.
It's impossible. I would just like to hit the weekly numbers more than
Right.
more than once a month or whatever it is. It's difficult.
So a couple random things, but Iran is probably taking an edge off the price. I mean, you said that the price got up to 100, but none of the futures price didn't get up there. I don't think Brent futures.
Well, Brent got up to 99.50.
Okay, that's close enough.
So
but it's but it's dampened now, and you think that's because of Iran coming on soon?
Yeah, I think that's definitely a factor. The U.S. is trying to say we're not going to. U.S. not trying; they are saying we're not going to sanction oil or natural gas, or we're not looking to sanction oil or natural gas. But it doesn't mean that there could be damage on the pipelines if there's a full scale invasion, or Russia pulls something. So and if they do, if there is a disruption, certainly there will be release of strategic reserves globally. I think we could look for that right away. So that's something else that could lend a damper. We have to see how events. We'll have to see how events play out.
The other interesting thing is refining. Would you say it's kept up with demand or it's behind?
Well, let's see. Margins, well, because Brent just went vertical, refining margins in Europe are horrendous right now.
Hmm.
U.S. margins are they're okay. The cracks have been rallying, steady. Runs still are, well, we're going to turnarounds now, but, we certainly lost a lot of capacity. There've been, and we've talked about this, over the last, I don't know, Jim, like 3 or 4 years, more
Yeah.
longer maybe,
Yeah.
of all the plants that have closed in the U.S. And that's demand for crude. So that's where we're not going to be where we were at the peak on runs. But that's the bad news. The good news is that refiners are running a lot more efficiently and able to produce higher yields of both diesel and gasoline, without that excess capacity, without that capacity. And most of those plants that closed were, you know, needed to be closed.
Your how can I put this? The runs in pad two are decent relative to history, right? I mean, they're a little bit lower, but not that much lower. But Cushing stocks are getting low relative to history. Is that, do you see that as a problem, or is it, is we back to
I don't
just
think
in
it's a
time
pro.
in?
I don't think it's a problem. It certainly has contributed to the backwardation, which is coming off some in Cushing. It's going nuts in Europe, but in Cushing, it looks like the M1 the futures, the WTI futures are softening somewhat. It's still well over $1, but it's not $2. I think the one thing about Cushing is that it's we don't need that much inventory, given that some of the changing patterns on these pipelines. Cushing is basically just like a train station. I mean, the train
Right.
comes in, goes out.
Yeah.
Boom, boom. So
Unless people are waiting. It's less barrels, and to just, you don't need to store them. They're just going right through it.
right. Yeah. It's a through station.
Through station, yeah.
It's a transit point. And so we probably need less. I don't know. The we're running at like half, actually, almost exactly half the 5-year average. So we probably need more than what's there. But operationally, I think I think we can probably get by with this kind of number. But higher would certainly be better.
Right. What else? Anything you want? What about prices going forward? I know this is anybody's guess, but what are you
Yeah,
thinking
it's
here?
anybody's guess. I'm not. I think you can tell by some of the things we've talked about. I'm not like crazy bullish here. I'm just not. I certainly, yeah. Could the market spike? Of course, it could spike. Depending on events. But if that deal is done, and with Iran, it's not done till it's done. That's a pretty big game changer. Obviously, what happens with Russia being such a huge producer and exporter, obviously that's a big deal. Um, and that one's kind of hard to handicap, but don't miss that there are there are reserves.
Are you
Um,
are you confident that OPEC Plus can eventually meet its targets?
no, they're
No.
not going to meet their total. There's no way. That's not now. No, you could add, maybe if you add, they're running like 900,000 barrels a day below their targets, and the key there is, as we've discussed, you have producers like mostly the African producers that just cannot make their quotas,
Mm.
no matter what. maybe if there's billions of dollars of investments pouring into those countries over the next few years, maybe by 24 or 25, they can make their 21, 22 quotas, but they can't, they can't now. And sanctions are still on Venezuela, but they're not really quoted. They're not under quotas. And the Saudis, the Persian Gulf producers seem to be indicating for now that they're not going to. The next meeting's March 2nd. We're still going to go on this incremental 400 a day, which is in reality 200 a day or less. The spare capacities in Saudi and UAE and Iraq. And, it doesn't look like presently, as we speak today, at this time, that's, Saudi really wants to increase production.
Right.
But if there's a disruption, the U.S. is obviously going to put on some there'll be serious pressure on the Saudis to increase. And we'll see, we'll see where they fall.
Right. Right. Yeah. It's so let's say that we get your 500,000 barrel a day build for 2022, and we have the demand that you have 3.6 increase. That's still going to be a tight market when we come out of the year, right? I mean, that's you're talking about.
Yeah. I don't think we're looking at any type of price, collapse into like the 50s, or maybe even the 60s. Could I see 70s? Yeah, easily.
Right.
I think that easily, if things clear up and in the Ukraine and the Iranian barrels come on and we start rebuilding inventories. And the other thing is there's a tremendous amount of length, and ironically, it's in the U.S. market, not so much in Brent. I think Brent's like 5-1, long to short. WTI is like 15-1. You start unwinding that too.
Right.
And the market could come off hard. No, maybe not hard. Could come off from these levels.
Yeah, there's an Omicron subvirus coming out, and I just was reading about it today. Apparently, it's even it's even easier to catch, but they think it's mild, so it probably won't have. It's like I think a small percent in the U.S., but growing. But yeah, we'll see. There's also the possibility of another sort of variant coming out, which we're I think we're kind of like saying, bring it on. We're going back to normal. Whether
like you said, as you said earlier.
Yeah. Well, I said before we got on the.
We had enough.
Yeah, I mean, I was telling Andy before we got on here that I had 3 shots and I got COVID 2 weeks ago, and now it's like I'm free. I'm going to my gym. I'm going out. And this area seems to be the same though. I don't see a lot of people wearing masks, and it is a very masked up place. So yeah, I think I think it's going to be a tight. I guess I get nervous when I'm with the consensus, and the consensus seems to be that this is a tight market, and we're more likely to go to something like 115 than we are to say 75. And I agree with that, but I just don't like being in that camp because I know I'm with the consensus.
Right. I mean, some people are you have some of the banks and analysts who are completely, who've like X'd out the bearish, some of the bearish variables, saying the market can't possibly go down.
Right.
And when that happens, you're in a dangerous spot.
Yeah, that's what makes me nervous. Yeah. I think I'd rather be a put buyer than a call buyer right now, but we'll see.
Yeah, me too. Yeah,
anything else, Andy, you want to add? Because it's this is we always say there's a lot going on, but this market is very fluid. Like I said, we tomorrow we could get a piece of news and everything's flipped.
Exactly. We've lived through a geopolitical developments in the oil market our whole careers, Jim, and certainly we went through two of the biggest in where there was a war in the Persian Gulf, which is one of the worst worst possible scenarios for oil. I think one thing that we did learn is what you think is going to happen, may not necessarily happen. And I think all of us who are of a certain age will remember the night that the bombing started in
Yep.
Baghdad, and everybody was like, "Oh, the market's going to the moon," and it went straight down.
Yeah.
Different scenario, different situation,
Yep.
but I don't think there were all that many people who were handicapping that it was going to go straight down.
No, not that hard, and no, not at all. I remember that very much. Big. It's one of the biggest drops in implied vol. We ended up going from something like 120% down to, I don't know, 85 in one day, and we got a lot of our customers short vol at 85. They're saying, wait a second, we just dropped so much. I said, yeah, but the response from Iraq was so sort of feeble that it was kind of somewhat clear that the market was going to bounce back from its collapse, but it was going to kind of move sideways more. Like the volatility, the worst days of the volatility was behind us, and we had some people sell 85% all the way down to 20, and they had some of their best years ever.
One night.
Yeah, only to. I used to give out those option of the year awards, option trade of the year awards, and I gave it out. And the next year, a lot of those folks gave a lot of it back. So it became the option trade of the year award became a curse. It was like it's like 4 years in a row I gave it out, and the following year the same trading group or person kind of got smacked around. So I stopped giving it out. Anyway, that's all I have, Andy. We are, I think, anything else you want to add?
Well, I want to, if you have any questions or want to get a hold of us, my email address is alebow at commodityresearchgroup.com. Feel free to just drop me an email. And I'm on LinkedIn, Andrew Lebow.
Great. And we'll see you next month.
All right, Jim. Thanks.